All right, we are at the top of the hour. Welcome, everyone. My name is Colin Brown. I'm with NACVA and the Consultants Training Institute. We want to welcome each of you to our webinar today, a case study, comparative financial ratios with key value data. Before we begin today, I'd like to cover a few housekeeping items. The first is how to earn CPE credit. To obtain CPE credit for this webinar, you'll need to answer poll questions that will pop up on your screen at random times throughout the session. You are required to answer all questions to verify your attendance in compliance with the standards of NASBA. 7 to 10 business days, that is no longer the case. Normally it's 7 to 10 business days after the webinar. You'll be able to access and print your CP certificates by logging into the member portal on NACPA.com. And CP credit will not be issued to attendees who do not complete the required poll questions. However, that is all true except for the 7 to 10 business days. We are currently about 2 to 3 weeks out on those. We've had so many free webinars lately, everyone wanting to get in that free CPE credit, and we're probably about, I think we're down to 2,000 certificates still remaining outstanding. But in any case, give it at least 2 to 3 weeks before you even check. There'd be no reason to even check before then. So be aware of that. And if you do have any questions today during today's webinar, you'll be able to submit those questions to the Q&A section of your Zoom toolbar. Please use the Q&A option for relevant questions for our instructor. If you have a generic comment or a technical question or a poll question, then you can use the chat feature for those types of questions. There are a lot of people on this webinar today and we'll respond as quickly as possible. Now it is my pleasure to introduce our presenter today, Dave Miles. And by the way, we just had a question come up. Will you announce it poll questions? We're actually not supposed to do that. I know it's really nice, in case, especially if you're not, if you're doing other things while you're watching this, but we're not supposed to announce the poll questions, just so you know. It is my pleasure to introduce our presenter today, Dave Miles. Dave is the Business Valuation Manager at ValueSource for the last 20 years. He has worked on developing software, developing web applications, publishing data sets, and providing valuation expertise to both customers and the ValueSource team. He identifies the what and the why of a valuation technique, tool, or database, and then passes on that knowledge. And we're happy to have him here and we'll turn the time over to Dave.
Thanks so much, Colin. Got another question in the Q&A. Will we get a copy of the slides? The answer is twofold. One, if you go to the LMS system, the slides are now posted. And the other thing is if you give me an email, dmiles@valuesource.com, and that will be at the last of the slide deck here, I'll be happy to send you a copy of the slides as well. And then somebody else is wanting a test of the polling questions so they know if it works. Is that something that we can do, Colin, or not?
Let me throw one together here real quick. It might take me a second, and I'll throw it up, and it will just be a test so everyone knows.
So during this webinar, a couple of things. These are my ideas, my opinions. You need to vet this information for yourself. I'm targeting this towards an intermediate crowd, not necessarily a beginning crowd, not necessarily an advanced crowd. And so, you know, now's the time when we start to say, oh, here's item A over here on the left side, here's item B over here on the right side, and how do I compare and contrast those, and what works for me in my particular practice. Today, we want to talk about comparative ratios. I believe that this is the meat and potatoes of the valuation work that we do. And somebody here is asking if you'd be able to see the speaker. I'm keeping my camera off today, so the answer is no to that. So anyway, today's objectives, we're just going to go through the databases that are out there on keyvaluedata.com. I know about other databases. I'll be happy to discuss those if you want. We want to talk about which ratios do we apply. And it looks like Colin has brought up the first test polling to see if you can see it. So you should be able to see it at that point. And the other polling questions I will not announce. Sorry about that in the past, Colin. Usually when that popped up, I said, oh, here it is, quickly answer it. But I won't do that today. We'll just close it out. We're going to look at different ways to identify an appropriate peer group, some of the issues in in looking at that peer group. As I said, we're going to talk about tips and traps in the data, percentiles in the RMA method, and we're going to talk about COVID-19 issues. So I thought to myself, actually not to myself, I was talking to my wife. I said, should I find a COVID-19 joke? And she said, she took a deep breath in and said, no, it's too early for a COVID-19 joke. So not being a comedian and not willing to take the risk, we are going to move on with the presentation here. What I want to make clear is that we are measuring the competitive advantages of a business, and that's the value that we're placing on that business. So when we say, hey, what is the goodwill of this particular company? We're saying, what's the intangible competitive advantages of that business? Let me give you an example of that. So I come from, the last 20 years I've spent in Pueblo, Colorado. We have a pizza shop on the south side of town. We have a pizza shop on the north side of town. These are hypothetical pizza pie shops. South side of town is where the mill's been in place since 1876. North side of town is where all of the new stuff is coming in at. All of the growth is up on the north side of town. Pizza pie place up on the north side charges $20 a pie. Pizza pie place on the south side charges $8 a pie. Now all of a sudden we start to say, okay, there's starting to be some differences here. Is there a competitive advantage in charging a higher price per pie? Then we start to get into more, even more subjective nature. And that would be, are there health citations on the south side of town? Is the equipment older? Is the location of it not as good as the north side? On the north side of town, we have ones where it's brand new. So supposedly there's not as many health citations. Now you would just assume, based off of that information there, that the one on the north side of town should have a higher market value, higher fair market value, because it has more competitive advantages than the other one. And so it should be priced at a higher amount. How do we determine some of those competitive advantages out there that we're pricing? There are two ways in my mind that we develop that empirical evidence. One is the subjective management interviews, and the other is through ratio analysis. Perhaps you've seen other presentations I've done about the market method, but I like to do the whisker plot. And so, when I have my box up here, the median's in the middle, the low 25 percentile here, the high percentile 75% up here, and that's my whiskers. How do I tell if my business is falling on the high side, or if my business is falling on the low side, or if it's just average? And that's really the question we're asking through the subjective management and through the ratio analysis. So in the subjective interview, hey, what product do you sell? How do you keep items in the pipeline? How do you keep your marketing up? How do you make sure that there's sales going on every day? And that's what we want to find out in our interview. For the cost of goods sold part of it, what's our supply chain? So during COVID-19, I've heard a lot of supply chain issues come up and say, if there's a break in it, you can't get a truck to go from point A to point B, and we have everybody with just-in-time inventories, and the next thing you know, we're out of toilet paper. That may not make a big deal as far as the valuation goes, but it does bring into point that if you don't ask about the supply chain and how they keep that in place and how they replicate it, if you only have one supplier of a product, it's going to be very difficult. What are your production capabilities? How many lines of tooling do you have? Are 3 of them old? Can you put your hand on it and you see the dust? Or does it, or are they all brand new and up and functioning? So David Cole out there has an item in the Q&A section for you. You can talk to him. Let's see, geographic environment. And geographic environment, what's going on in your town. Pueblo has a much different feel than Denver. And so you need to make sure that you capture that inside of your subjective interview. Look at internal threats. Are there, problems with your personnel? Are there easy to get personnel? Hey, I have a pizza pie shop here. Can I hire people to come in, make the deliveries, make the pies, and serve the customers? And so those are kinds of things that you would qualify inside of a subjective interview. And really what we're trying to do is we're trying to determine what's the risk in achieving the cash flows that we're going to say are in the future on an income method. We're also trying to come up with an idea of saying, okay, is this here company better situated in the market than its competitors on those comparative transaction analysis in the market method? All of those answers are going to come across as, I think they're better, it seems better to me. What I really like though is when you start to calculate ratios. And when you look at the calculation of ratios, you know, now all of a sudden we start to get some empirical evidence. So it's real easy for me to say, oh, look, here is the operating leverage of this particular company, and this operating leverage is what allows it to make all of its profit. And you can see that through the numbers, you know, and you can do that on a current period, or you can do that on a multi-year spread. So on the current period, basically we go through and calculate all of those, and I'm going to soft pedal my wares a little bit. It's not that I'm trying to sell anything here. It's just, you know, if you have templates out there that do this sort of thing, I think that's the way you need to go. I know that the software we have will automatically calculate a lot of these ratios and put the current period in there. But make sure that it goes to the next step and actually is developing information that you can use to say, hey, my company is stronger in the marketplace, therefore it deserves a better price. Or conversely, my company is weaker in the marketplace, and therefore it deserves a weaker price in the marketplace. And like I say, I'm not trying to stand on one side or the other of that chasm. I just know that that chasm exists and you need to take a look at it. Then the other thing you can do is you can compare that to a peer group, and that's what we want to talk about. A couple of traps when we talk about these ratios. One of the traps is that, well, how do I want to say this? You can calculate the ratios on the internet. Here's how you calculate it. Usually you take something on the income statement divided by something on the balance sheet. And when you do that sort of thing, and you're looking for turns like inventory turns or something like that, you have to be careful. Are we talking about the beginning of the period or the end of the period? Or are we talking about an average of the period? Probably in the practical nature of things, it doesn't make a huge difference, but you should be aware of that. I do know that you know, one of the internal inconsistencies of reports is to use a database, a peer group setting that uses an average balance as opposed to the end of the year balance. And by not calculating it the same, you come up with a slight difference probably. And that slight difference, you know, detracts from the credibility that you might have inside of the report simply because you didn't know that you were supposed to take an average balance. Like I said, in reality, the numbers are probably not all that different anyway. And if somebody's doing window dressing, which they do at the end of, you know, maybe not super small businesses, but, you know, corporations will go out there and say, hey, how do I make my inventory really small at the end of my period? You know, that's why a lot of sales happen. And so that inventory can get small and it looks like your inventory turn number is a lot better. And so you have to ask yourself, am I really seeing the financial picture of this company? And is it accurate? And so you can look at that. I think that's one of the reasons why CPAs tend to do well at business valuation, is that we tend to do this kind of analysis and we can read the financial statements and see what's behind the numbers. But don't take that to mean that anyone else can't do that, because a lot of times people can read and analyze a financial statement as well as or better than a CPA. We just have spent 4 years in college or 5 years or 6 years in college learning how to read financial statements. And so you would think that we could do that well. So that's the traps with ratios. This is, how am I calculating this? Is it really an accurate representation of what's going on in the background? And so sometimes with our templates, we tend to go over the analysis of it too quickly, and we don't really think about what's going on underneath it. And so I wanted to bring that trap up with the ratios. One of the things that I wanted to bring into account here is DuPont analysis. Now, I'm under the impression that most of us know what DuPont analysis is, but I want to get into it a little bit because it can help us when we're valuing a company. And basically, if we take the return on equity, that's equal to the profit margin times the asset turnover times the financial leverage. And so when we look at this, we can say, okay, what's the profit margin? You know, that's obviously the profitability. And you can break each of those down into smaller subsets too. But I just want to give you an idea of saying, you know, if somebody has a high profit margin, you know, let's say it's 0.9 or 0.8, but they don't have very good asset turnover, you know what I mean? They're going to have a much different return on equity at the end of the day. And that return on equity is a substitute for, you know, what is the required investment to have somebody attracted to these cash flows. And so when you start to look at this, it starts to make sense. Then you have other people who have high asset turnover, but they have low profit margins. And if they have that kind of asset efficiency, then they're making most of their money by supply chain and saying, you know, am I bringing something in, producing it, and getting it out the door? And we'll talk about a couple of those. And then you get the one that's driving me crazy these days is the financial leverage. And so underneath the financial leverage, it's the equity multiplier. I have a couple of Q&As here. Are you suggesting that the formulas on the internet are wrong? No, I don't think the formulas on the internet are wrong at all. What I believe is that when you start to take a subject company and you start to look at what's inside of there, you have to ask yourself, is this real or not? So for instance, the inventory turnover rate. I have talked to people who have valued companies that have a huge, huge amount of inventory. And the reason it's huge is because they have a part that goes back 50 years, you know, and so they can, if you're looking for a tractor part, you can go to them and you know that they have that tractor part, but they're only going to sell that part once every, you know, 5 years or so. And so their inventory turns are really, really small. So I'm suggesting, am I getting an accurate picture for that particular company because their inventory turns are really small? On the other hand, you know, you have these high level ones that where you have a lot of inventory turns, and you're saying, am I looking at the right picture here because of that? And that's where that subjective nature has to come into the empirical nature here. So I'm not suggesting that you look at the formula and say, oh, the formula is wrong here. If I need beginning inventory plus ending inventory divided by 2 to give me an average inventory, I think that's great. What I also am saying is that when you start to look at average inventory as opposed to end of year inventory, you have to ask yourself how much reward is there for the benefit of going back and picking up the beginning balance and dividing it by 2. And a lot of times, you know, last year's inventory and this year's inventory pretty close to one another. You're not really getting that much more out of the number by choosing an average, but you never know. And you know, you can also have weird years. And so if you have a weird year out there where the inventory is really small, and then the next year the inventory is really large, maybe taking that average inventory makes the most sense. On the other hand, if it tends to be very steady and very, very stable, then taking an average inventory does not make a lot of sense. And so I'm suggesting in the Q&A, or for the Q&A question is that, yes, look at the formulas, but understand what the math is behind those formulas so that you can make a good indicator. Too many times I've seen people, I come from the auditing background, and too many times I've seen juniors just say, hey, here's the number, kick it in here, here's what it says. And they didn't really do a good enough job of saying, you know, should we study out this problem a little bit more? You know, the inventory turns weren't right, so should we do more work on the inventory? And that's all I was trying to suggest with my numbers, not trying to suggest that one formula is better than another formula. So I was talking about financial leverage. Financial leverage is basically debt. So, you know, we can get into debt, but it brings up a whole bunch of questions in my mind. We use weighted average cost of capital. So we're trying to bring a capital structure to the deal. You know, if we don't have capital structure to the deal and it's a minority interest, you know what I mean? What kind of financial leverage is sitting on there? And how does that play into the valuation? So it's important to look at all 3 of those items and figure out what's driving the business, because as you find out what's driving the business, you'll be able to make a better determination as to what's the likelihood of receiving the cash flows that we're forecasting. Real quick example, if we have a profit margin of 0.10, asset turns at 2, financial leverage at 2.5, then the return on equity is 50, 0.5. If we have a 0.9, that ROE goes up dramatically to maybe 4.5. And so it's really important to see where that profit margin is coming in at, and see where the asset turnover is coming in at. And it's kind of a dry topic, really. You look at the DuPont analysis here and you say, what's going on with it? Okay, great. Works for manufacturing companies. Does it work for service companies? And I think that the trap is that it works best for comparing similar companies and trying to get an idea of which one's stronger and which one's weaker. Or it's really good at figuring out trends from year to year. So a lot of times we'll take our subject company and we'll put it on a 5-year spread, and then we can look at the DuPont analysis for that 5 years. And I believe that, the software does that, and I believe that your template should do that as well, so that you can look at that and say, okay, what is changing here from year to year? What's driving my numbers? And once you figure out what your key drivers are in the business, then you can have a better sense of what really is that probability of receiving the cash flows that you're going to forecast here in a little bit. And so, when we compare similar companies and when we compare trends from year to year, I think is where you can get a lot of value out of this DuPont analysis. I will say at the same time that our software doesn't take the data sets and convert that into DuPont analysis. I gotta work on that one. I think it's a great idea, and I think we should do it more. So let's talk about high profit margin type businesses. These are going to be like fashion industry people. So, you have a real low cost of manufacturing, but you can sell products, at thousands of times what their value is. Louis Vuitton, some of the other ones. Experts, I think, out there. So, I talk about experts that start with and these are financial experts that go to court and litigation. They start out at, let's say that the person I'm thinking of, charges $500 an hour, starts with a blank spreadsheet and a blank Word report, and that particular project, that particular engagement is 100% expert driven. That is a high profit margin type business. It's a service business, and that brings into question, okay, as a service business, can I really use a DuPont analysis? And the answer is yes, if you start to compare the company against itself, or you start to compare the company against, other like-minded companies. Obviously, most of it's going to be in the profit margin, but there can be some issues there with having, debt on board. Can we hire people to do some of the work for us or not? I think iPhones is another high profit margin business. So while I'm not trying to get into the R&D cost of the iPhone, what I am trying to say is that the cost to manufacture that are pretty low, and the price is pretty high. The reason I say that is because if you look at computers, computers are pretty low priced, and what makes iPhones cool is their design. And so high profit margin there. So some of the COVID-19 consideration is if you have a high margin company, will the market be able to afford it? Will the market come back and be able to afford it? And so, back March 31st, you're saying, hey, what's going to happen here in the next little bit? Is the market going to be able to afford these? So your cash flows are probably going to have to go down. And I realize that we all know that, but this is the thinking that you can lay out inside of your process and say, the reason that the cash flows are going to go down is because people are not going to spend, $1,500 for a piece of luggage or a bag. They're going to push that off a little bit. Or maybe it's the other way around. Maybe it doesn't matter. And so they'll be able to afford that. It just depends on the business, right? The next one are the asset turnover companies. So these are going to be volume producers. I want to say like Walmart, Target, those people are looking at turnovers and saying, I bring this in and I only sell it for 10 or 15%, grocery stores. And so they want to have a high amount of inventory turns. So if you were doing a business that is driven by the asset turnover ratio, what you want to make sure of is that you're taking a look at this and saying, what kind of supply chain issues am I going to have? How did COVID-19 stop that? So you have a grocery store that's supposed to have toilet paper. It can't sell toilet paper. It's not making its cash flows. Again, That's a smallish example of how that works. But I think that when you look at the bigger picture and you say, how does the supply chain work? Can I replace elements of the supply chain? I think that COVID-19 does bring into play some lessons for us in that we can start to question these items in the future, not necessarily because of the pandemic, but to say, wait a minute, if the supply chain broke during the pandemic, how would it break in other cases? I believe that, you know, we talked about the financial expert with the high margin. I'll go to the other end here and say, if you're doing small business association valuations, you know, that's a grinding business. And so a lot of people are out there doing it at low cost and trying to churn those out as fast as they can. And, you know, they make a good living at it, but still, it's about that turning over of that process. It's about making sure that there's enough in the pipeline, enough engagements coming in that you can churn those out so that you don't have to make it up for it in the margin. As I said, financial leverage, this here increases profits as well as increases losses. So as you bring on your debt load, you know, you have to be able to service the interest and service the principal payments to do that. And if you don't have the cash flows to do that, your business crumbles very quickly. By the same token, if you don't take on any debt, then what happens is that you could be purchasing working capital items, whether it's inventory or other things that would optimize your returns. And if you're not optimizing your returns, you're also putting a drag on growth. And this kind of leads me into a segue out there. So when we look at the differences between using a weighted average cost of capital and using a equity value on its own, when you try to reconcile those two methods, because really the cash flows aren't going to change that much, your capitalization rate is not going to change that much. But what changes dramatically is your growth rate. And that's because an under-leveraged company cannot grow as fast as a leveraged company. It's just that simple. And so, you know, when you put in your inputs, I have a person out here saying, Greg says, the drag on growth is not reinvesting profits. I'm not sure what point that you're looking at there. What I'm trying to say is let me give an example here. If you have a house and you buy it, and you know, you borrow money, you can buy a lot more house than you have down payment for. That house grows in value and you sell it at a higher price. Because you borrowed the money, you get to include the whole amount of equity. If you had to buy a house that you could only afford the down payment for and it grew in equity, it would be much, much smaller, and that percent of growth would be much, much smaller. So let's, you know, you can run the numbers in the background and see what that looks like. But that's what I'm talking about is that drag on growth is that you can't grow your cash flows without the benefit of leverage as fast as that with debt. It makes sense to me. So if you have a manufacturing company, you borrow money, you can buy more what am I thinking of, raw materials, and then you can hire more people to produce more materials, and then you can take that materials, have more inventory to sell, you sell more inventory, you get higher cash flows. But the problem with that is, if you over leverage, then you also run the risk of not meeting interest and principal payments. That's what COVID-19 did to us, is all of a sudden the cash flows dried up, and boom, can we pay back all of that principal and interest? And obviously people can last a few months on, you know, negotiations and borrowed time, but they can't last a long, long time on that. And that's what the whole economic discussion is right now. Has to, in my opinion, it has a lot to do with this whole interest and principal repayments. How do we make sure that banks and those types of people are being kept whole? Also brings into question, what is the optimal capital structure? So when we start looking at this financial leverage, again, what are you valuing? Minority marketable interest, controlling interest? As you start to look at those things, you know, what are you going to put into place? M&A people are going to bring their own capital structure. And so they'll be able to put in their own financial leverage into that DuPont. what I'm trying to get after here is that the DuPont formula gives us a lot of power to describe how a company makes its money. And as it makes its money, we can look at that. So I have Greg out here is saying the return on invested capital has to be greater than the weighted average cost of capital to be optimal. All I was trying to get after, Greg, is not necessarily saying, what is optimal. What I'm trying to say is that it brings into question, if you're using a weighted average cost of capital, what's the weight of debt? What's the weight of equity? And you have to make that decision. And it's a big one, because like I said, all of a sudden now, if you're pulling the debt out of this, you need to look and see what happens to that growth and see if that makes sense or not inside of the evaluation that you're doing. So probably not being as sophisticated as you are, trying to keep it simple. So when I compare myself to a peer group, so the first thing that we do is we compare the company to itself. As I said, we put our 5-year spread on there, we calculate these ratios, we look at it, we try to see what trends are happening, what changes are happening, and we can go in and do that analysis pretty easily. The other thing that we need to do is compare ourselves to a peer group. So Corey out here is asking a question saying, would you create a cost of sales if you can identify those costs to create a gross margin where the industry may not show a cost of sales? I think if you look at the DuPont analysis, you don't have to have the, we're not talking about the margin, revenues minus cost of goods sold, to come up to a margin. I think we're talking about the profit margin at the end of the day. And so that's a whole different story inside of that DuPont analysis. But I'm not sure if you can break that up and have two additive pieces inside of there and saying, is it really in my cost of goods, or is it in my selling and general expenses that I have my hard times? In other words, my fixed costs versus my variable costs. That's all under operating leverage, and you can go through and answer the questions and look at the analysis of the operating leverage to find out what your optimal pieces are there. I'm not sure I answered your question, Corey. I do like talking about this stuff, and this here is a little bit harder to do since it's so generic, and I'm not as well versed in it as I should be, but we're going to throw it out here and go with it. I think you guys will get the information. So the first thing we do is we compare the company to itself. Then the second thing we do is we want to compare it to a peer group. And what the peer group does is that it allows us to a point of context. And so as we look at our point of context, we can say, am I stronger in the market or am I weaker in the market? Because as I start to look at stronger and weaker in the market, we can also ask ourselves the question, are these cash flows realizable or not? And what's the probability of realizing these cash flows in the income method? And some of the traps when you compare yourself to a peer group, and like I say, in the beginning, beginning users, it's real easy. You go out, you find the industry code that you're looking for, and then you look at the size characteristic that you can come up with, boom, slap those numbers together, give yourself a comparison and say, okay, what's my next step? And the analysis just tends to be cursory at best. And I want to try to do a little bit more, a little deeper dive into what it is we're really saying here. So I have somebody out here saying, I would suggest that small to mid-sized companies do not focus on optimal capital structure. Actually, these types of businesses generally require personal guarantees from the owner, which is probably equity rather than debt. Totally agree with that, John. In fact, most small businesses would tend to run without debt simply because they don't want to run the risk of going out of business. So they're willing to give up the top end profits, top end ability returns to gain the reliability of generating those cash flows so that they don't have to worry about servicing debt. And that's one of the questions that I think comes into play in all of our minds is when we're talking about this. So if we're talking about a debt-free structure, is that the same thing as weighted average cost of capital or not? That's one of the simple questions that comes out of that. But I totally agree. Small and mid-sized companies would tend not to focus on debt because it's difficult to get. But they give up the top side profits. So back to comparing myself to a peer group. Industry codes are not always what they seem. And so when we go into these different data sets and we try to come up with the idea of saying, here's a particular industry code. For this particular session, we wanted to come up with, so as I said, I come from Colorado. You know, my daughter's 5th generation, Douglas County. You know, she asked one time, she came home from school and said, Dad, where do we come from? And she was looking for a European ethnicity, but I didn't play that game. I said, you come from Colorado. She said, no, where do we come from? I said, well, how far back do you want to go? Because I can go back 5 generations here in Colorado and say, so you come from Colorado. You know what I mean? And she wasn't happy with that, but you know, when you think about it, how far back do we go? In Colorado, there's a company that makes the Grammy trophies, and those Grammy trophies are built all year long, and he sneaks them into LA for the presentation, and he's been doing it for many, many years. And so I've got to think of what about a metal plating business? And that's where this came up. So I'm looking at a metal plating business. The NAICS code is 332813. When I look at that, where does that 332813 come from? And when I look at the different data sets, I need to make sure that I'm taking a look at this and saying, okay, there's probably not any better information out there, but I need to be cognizant of the fact that when I look at the IRS data, you know, I had a person tell me that the IRS was 25 to 33% wrong on their tax forms. Now, the statisticians at the IRS are going to have to make the assumption that that NAICS code is correct, but it may not be correct. And so we have to ask ourselves, as we start putting that information together, what's going on with it? So if we start to decrease the size of our sampling, and we go from, you know, and like I say, we'll talk about the IRS here in a minute, we go from 33,000 codes or 33,000 items that we put into the sample to come up with our averages, you know, and that drops down to 8 or 9. Is there 8 or 9 companies that are all doing the same thing? And are we making that assumption? And is that a good enough assumption? So industry codes are not always what they seem, especially as our sample sizes decrease. And I'll show you what I mean by that. In the super micro businesses, you know, we have printing out there. And as we look at the printers, you know what I mean? I have seen an observation come into our comparable transaction database, and it said printing on it. And then when we dug a little bit deeper, these were screen printers that printed t-shirts on a beach somewhere. And so, you know, you walk into the store, you say, here's the one I want. They take your t-shirt, lay it over things, screen print it right there in front of you, and off you go. That's a little bit different than somebody who's a commercial printer who has all of those large machines, which is still a little bit different than, say, for instance, a UPS printing store. And so you have to be a little careful what those industry codes are and what they seem to be. I also want to bring up the idea that the whole is not the sum of its parts. So as we start to compare ourselves against a peer group, we are not comparing ourselves from company to company. We are comparing ourselves usually on a ratio to ratio or line item to line item basis. So in other words, if we look at the profit margins on a income statement, you know, is that the same thing as saying that the cost structure is the same? And I don't think you can do that, and I'm going to show you that as well. So as you look at each individual item across this grouping, you have to say, does it add up to the whole? And you're going to have to make a way to come back and say this company is stronger as a whole. And it's not going to be stronger because of one item or 2 items. It's going to be stronger because the key drivers do this. It's going to be stronger because those key drivers are backed up by this empirical data. And that's why this company as a whole is stronger than it's the sum of its parts. And that's what I'm trying to get at, is saying, don't think that there's just a button you push here and it says, oh, the company has a grade of B, so it goes into just a little bit above average. Or this company has a grade of C, so it's just going to be in the average area. Typically, when we compare ourselves to when we compare our subject company to other companies, we are comparing ourselves against product, size, and geography. And that brings into play this whole idea of saying, what is the product? So back in 1989, when Shannon Pratt did the Hallmark card case, and I'm sure we've all heard this, he did not compare it to another card company. He compared it to a novelty company. So when we're looking inside of our peer groups here to compare ourselves as an industry analysis, you know what I mean, are we comparing the right product against the right product? And I did that just a moment ago with that t-shirt printing company. And, they're selling t-shirts, basically retail, and they're doing a little bit of manufacturing on the side. They're not really a printing company. By the same token, he said that Hallmark Cards was not really a card company. It was more of a novelty company. And so he compared against other novelty companies like Coca-Cola. Size is an interesting issue when we do peer group analysis. And the reason size is an issue is because we want to get small companies, because we know that small companies are behaving differently than large companies. And if they're behaving differently than large companies, can we use a large company as a peer group indicator? Probably not. So where does that size indicator break off at? And how do we compare ourselves? And I'll show this here in a minute or two with the IRS data as well as with the RMA data. As I start to look at a size category, what really am I trying to compare? And keep in mind that the size of the company is not necessarily the driver of the company. It's simply an indication of how large it is and what its scale of operations are. And so when I try to say, okay, it has sales of this amount or it has assets of this amount, we have to ask ourselves, why is that sizing a great way to describe this company? Not necessarily, this is the amount of assets it takes to generate this kind of revenue. And then geography is always interesting. My favorite example with geography is I believe it was the early 2000s when, or maybe it was the late 1990s. I forget. It's what happens when you're around for 20 years. The textile industry in the Southeast area had decided to move into Mexico and into the Caribbean, Dominican Republic. In fact, my cousin went down to the Dominican Republic to work in the textile industry over there because it moved out of the South. On the other hand, textile industry up in the Northwest did not do that. And so geography, if I'm comparing myself to the textile industry in the Southeast, I'm going to have a much different viewpoint than if I compare myself to the Northwest. Unfortunately, a lot of the databases are going to be national in nature. Is it good enough? You know what I mean? Can I make the comparison that my company in Pueblo, Colorado is the same thing as the national company or the national averages elsewhere? Likewise, if you're in a very large city, let's say you're in Los Angeles, Houston, Chicago, New York, you know what I mean? Would it be fair to say that your company should be compared to the national averages because you have different issues when you're in a larger geographic region like that? But typically we compare ourselves product size and geography. And what I would suggest to you is think about how you're making those assumptions when you're doing your peer group analysis. And I think that should you tie those assumptions in your report and make the reader of the report connect the dots, I think you'll have a more credible report. So William out here says, since it's advised by health professionals to look away from screen periodically, a jingle on the screen change or polling questions might be appreciated. So I think that what I want to do next is talk about the different databases that are available out there. I think we need to ask ourselves some questions. We're looking for sufficient evidence. We are looking for competent evidence, and we're looking for relevant evidence. And I like to pull those terms out of the credibility issue. Frank, I can't remember his last name, but he wrote a big book about all of this. If you want to be credible, you have to have sufficient evidence, you have to have competent evidence, and you have to have relevant evidence. If you're not, then you're not going to be credible in your reporting. I believe some of those words also probably come out of our standards, depending on where you come from, ASA, AICPA, CVA. So those words are used in there as well. So when we start to look at the data, we have to answer those questions for ourselves. And so we need to ask, where does the data come from? In one case, it might be coming from loan officers. In another case, it might be coming from tax returns. In another case, it might be coming from a whole bunch of different databases, and it's being modeled. But where does the data come from? And is the process to obtain those numbers transparent, or is there a black box objective inside of there? And I don't want to say objection. I don't mean it. Frank Rosillo. Jeff, thank you so much. Frank Rosillo is the name I was looking for. Frank's a great guy. You know, wrote a book on this stuff, and you can learn a lot from him. In fact, he was the one that put together the A-bar program, to give you an idea. Anyway, are the numbers transparent, or is there a black box objection inside of here? So if these numbers are being modeled too tremendously, you have to ask yourself, is this modeling okay or not okay? And can I follow it? Should I believe it? Likewise, if you're getting data from the RMA, we'll talk about this in a minute, you need to realize that these here are coming from people who are trying to obtain loans, or trying to maintain their loans. And so that is some issues in there. How are the numbers transparent? One of my favorite is are the numbers biased? If they're biased, then you need to look at that. Now, we're going to run into that bias problem with the COVID-19 issues that are happening now. I believe that the 2020 data that's going to show up in our peer group numbers, and I'm not sure if that's a year from now or a year and a half from now, are going to be twisted a little bit because of the COVID-19 shutdown. And so we're going to have to say how much of these numbers are biased. Can we use them? I also think that you need to look at how granular the data is. And remember, I was talking a moment ago saying, do I compare myself across the nation, or can I split this up into a region? If I can split it up into a region, do I have enough of a population to say that this makes sense for me? What are some of the strengths of the data? What are the weaknesses of the data? I don't believe that one database is better than another database. A lot of it depends on how your practice is. I come back to this idea of saying, if I can identify the strengths and I can identify the weaknesses, now I can start to say, is this sufficient evidence? Is this competent evidence? And is this relevant evidence? And if I can answer those questions and draw the dots in the report, I think you got it. Okay, enough of my soapbox here. KeyValueData.com has many different types of peer group data. We have Bizminer, First Research, IRS Corporate Ratios, RMA Valuation Edition, and maybe you can get into the guideline public company data. I know that we dropped down full financial statements, and it has its own peer analysis, peer group analysis, ratio analysis, not peer group analysis, I apologize. It has its own ratio analysis on there. The problem is can you find a public company that you want to compare yourself to? I know that I've talked to a lot of regional firms, and they tend to do the guideline public company data more so than some of the smaller companies, simply because that's the size of client they have, and it makes sense to do it that way. You might be able to look into the archived industry and metro reports and see if there's some source of data that the industry tends to use. For instance, a trade association or something along those lines. And as we talk about these different ones, I'll try to highlight some of the advantages and disadvantages of those particular items. So a lot of this data can be obtained by purchasing a subscription level from NACVA or Value Source. And inside of that subscription level, you get different downloads of different things. One of the items out there is Bizminer. And Bizminer can be purchased on a per report basis or an annual subscription basis. Not trying to sell anything here. Annual subscriptions around $1,000, per reports around $150. What I tell people who are new to this business or do very few engagements is probably look at this Bizminer. I'm going to talk about First Research next, or First Research, and purchase these reports on an ad hoc basis. In other words, I have an engagement. Let me purchase my report from Bizminer. Let me buy my gold or silver level from the levels, and then I'll supplement that with anything else that I might need. Say, for instance, DLOM or something like that. And probably for $1,200, $1,500, you can get into the world of valuation pretty easily, which is a lot different than in the past, where you had to do a lot of this. So in the past, Bizminer, was an annual. I shouldn't say that. I don't know about Bizminer. A lot of companies only had annual subscriptions, and you were paying $800 or $900 for a subscription, and you only did 2 or 3 valuations. It was pretty harsh. But Bizminer is available on a per report basis, and I would suggest you look at getting just a single report until you can build up to get that annual subscription. There are data points that come in this report that go against what we're talking about. Hey, here is my asset turnover, here's my profit margin, here's my common size balance sheet. And I can start to look at these items, pull it into that DuPont analysis thinking, and start to determine what are the key drivers of my business and how does my business stack up against this. Those data points, well, let me talk about the next item first. Reports also include industry research. So if you're talking about a manufacturing industry, you can say, oh, this tells me about metal plating businesses and what's going on in the country about metal plating businesses. So it gives me my industry research as well. And so, you know, I can get my national economy taken care of, then I can get my industry economy taken care of, and I might be able to do something with the, you know, the metropolitan area on my own is where I'm trying to come from, and say, okay, inside of there, you can pull all of that. What you have to be careful of in Bizminer is that they have this idea of backcasting. So a lot of databases for peer group analysis takes a whole bunch of different sources of data, and then they pull all of that together and they create models that go back in history, go back in time. It's called backcasting. It's just like when we look at our cash flows, we're forecasting those cash flows into the future. And so it's future. When you cast it backwards, it's backcasting. The nice thing about backcasting is that you have a number for everything. In other words, if you don't have a particular ratio because information is missing off of the financial statements that you're trying to analyze, you know, you're trying to pull this group of 15 financial statements, but they don't have enough of them in there to calculate the ratio. In backcasting, you have a model and you can create an algorithm to do that. So this here is the language that Bizminer uses and says, hey, you know, we create those types of things that are going backwards. And, you know, we have algorithms. So these algorithms are pretty good at predicting what the past should have been. And that's the nice thing about backcasting is that you get some good numbers out there that are saying, here's where this should have been around. And so you can say, hey, am I close to the industry? Am I above the industry? Am I, you know, behind the industry? But what you are missing is that you're a step away from reality, and it's not necessarily saying this is what actually happened. I like Bizminer a little better than First Research because First Research uses Microbilt, and Microbilt will actually update their data every quarter, every 5 or 6 months, somewhere in there 2 to 3 times a year is what they've said in the past. I haven't looked at them in a long time, but as they update that data, the history will change. So in 2017, if you had a common size cash balance of 5%, they recalculate that, and now that common size balance sheet might be 6% for that same year if you run it at a different place. So John out here is saying the RMA book and the value source RMA data is sometimes different. Any idea why there are differences? That's a great question. And I'm not sure specifically when you say that there might be differences. What I know about is that the RMA book will have things like NA or 999, and our data inside of our database has a different number on that because we don't represent text with numerical fields. It's a SQL database, and so as we do that. But as I understand it, the RMA book and the data itself should match up. And if it doesn't, then we have to figure out why. And so if you're aware of a specific instance, John, please reach out to me because I want to figure out why that's the case. I know that we had a problem looking up a particular regional range here in the past, and we fixed that. So hopefully that's what that's about. But if it's something else, like I say, I need to talk to RMA and find out why we have a different number. First Research comes from Dun & Bradstreet. And by the way, if you go out to bizminer.com, you can read their FAQs, you can see what different products they have to offer. I would suggest that you go through keyvaluedata.com to get there. Because, you know, that supports NACVA and the CTI, but go out to bizminer.com, look at their FAQs. They have sample reports, and they have a lot of different products that may help you along the way. So I'm saying there's a stair-stepping of products. Here's industry data only. Here's data with financial information in it. Here's information about the whole industry, and they kind of stair-step up, and you can take a look at that. First Research is kind of the same way. It is a report that can be purchased individually or on an annual basis. And when I say annual basis, you can pull down as many reports as you want. Per report would be saying, hey, let me find out 332.813 is the NAICS code, pull down that report for me. It is put together by Dun & Bradstreet. I have another question here. Any plans to add vertical IQ if it's not already included in the database? David asked that question, and vertical IQ is a product of BV Resources. BV Resources and Value Source, we know of each other. We work together as competitors, but we are competitors. And so I do not believe that vertical IQ will be implemented inside of here. As I understand it, vertical IQ is also about industry research and coming up with, here's my particular industry. And I can't remember if they have the industry analysis in there, but I believe they do. Look and see who provides those numbers, because as I recall, vertical IQ was an aggregator. In other words, it pulled in information from different sources and put it together in a nice format. And so I think that they might be getting their numbers from Microbuilt as well, but I'm not positive on that. And certainly I could be lying here. Vertical IQ could be something totally different than what I think it is. And if I did, I apologize to you all. So Dun & Bradstreet goes out, researches these industries and puts things together. Data comes into the report. And it also includes the industry research. As I was saying before, Microbuilt puts this together. Microbuilt used to be Integradata, if you've been around for a while. David, I can't remember his last name. I sat down with him when he was first here, probably in 2007, when he was putting this database out here to the valuation marketplace. And it kind of blew my mind when that cash balance could change when they update the data. On the other hand, the data has a number for everything. And so if I'm trying to say, hey, the industry should have been this, and my number goes to here, then I have that. What's interesting to me is to know that both of those approaches are going to be acceptable inside of a valuation report. When I say valuation report, you could also put a forensics report or whatever. If you're doing this kind of work, both of those methodologies would be acceptable. The question is how do you explain it for your credibility, and how do you put it together? If you acknowledge that this is backcasting and that you're using it as a representation of the marketplace and it has a number for everything and that makes it easier to compare yourself to the industry, that's great. But if all of a sudden you're trying to do a normalization entry against a number inside of there, that's not an actual number and you could have some problems. On the other hand, if you're using something like RMA data or IRS data, and you're trying to say, hey, here's the numbers that were actually there, and I'm going to make my entry off of it, okay, but you're not going to have a number for everything because in real life, there isn't a number for everything. And so a lot of times you'll be missing a particular piece of data. Anyway, I just find it interesting that all of these work, and I'm not trying to say which one is better, which one is worse. So I want to talk about the IRS corporate ratios first. The IRS corporate ratios came into, you probably already know all of this, 1913, 16th Amendment to the Constitution gives them the right to levy taxes. 1916 is when the Revenue Act mandates that the statistics are published. In other words, we're taxing the citizens of the United States. If we tax them, we need to be able to find out if it's working or not working. And that same Revenue Act, that's what created the predecessor of the Statistics of Income program. And so these pieces of information have to be published, and we are capitalizing on that inside of our world to say, oh, here's the statistics of income for the corporate taxes. The first one was published in 1928 for 1926 data. I have some Q&As before I climb on my high horse here. So, okay, those are just about CPE stuff. On my high horse, I believe there's a logical fallacy of recency. So I think the IRS data has gotten a lot of hard hits in the past saying information is old and stale, I'm not going to use it. And my answer to that is that just because information is newer doesn't mean that it's better. And I think that there are a lot of pieces of information in the IRS data that you can get over simply because you can say, hey, this here is representative of the industry as no other database out there is. In other words, all the Form 1120s that were captured in a particular year are statistically analyzed by statisticians, and that information is put together and saying, here's what an average tax return would look like, given its size, given its industry. And by putting that together, saying you have a larger sample size, more accurate data, you're not using a model anymore, and you're not using information that's pulled in with very small sample sizes. So it doesn't necessarily mean it's better. Don't want to say that it's necessarily better because it's older. Just want to say you can draw lines in that comparison. And that's really what we try to do as valuation professionals, is try to say, here's my subject company. There is no direct connection to a proxy. And so I'm going to use another data set as a proxy, and I have to twist the information to fit it in there. Sometimes it fits really nicely and sometimes it doesn't. And it's our ability to make that comparison in our reports, draw the lines, connect the dots that make things work. But I do think that we get the logical fallacy of information is newer is not necessarily better. So basically, the statistics of income takes all the Form 1120s, puts it together in a package, then ValueSource takes that and we compile it into the format of the RMA calculations, and we put out the IRS Corporate Ratios. So basically there is a Form 1120 that's behind that. You can go out to the irs.gov, look at those Form 1120s from the different years. The average tax forms are split into size and industry, and that in 2014, those are the data years, the data years got changed so that it was either only size or only industry, but not both size and industry. And right now we are struggling to try to get comparability between those two different data sets. I think that this year here, we're just gonna have to put it together. We'll have all 3 years, 14, 15, and 16, and say, here's the size only or the industry only. And if you're trying to do a multi-period analysis, let you choose a crosswalk to say, how do I wanna go through and put that into place? There's a column of data that will match. The question is how do you want to make that match? The data is, or it does take 3 years to put all of that together. So right about now, the 2020, there should be data from 2017 out there. As I said, ValueSource hasn't processed that yet, but I'm guessing in the next 3 or 4 months, we'll get that up there, and you'll be able to see that data inside of there. Right now, we go back to 2013. So David out here says, does it really make any difference that one may use tax data, one may use book data? In other words, should we endeavor to adjust the data to something closer to economic data? That's a great question. And I was trying to get at that in the front. The ratios may or may not be what you think they are. I just saw Charles's thing. There's no such thing as voila. The word is viola. I was living in Montreal for a few months, and the person that I was living with used the word voila a lot. So I will give it to you, Charles. Back to David's question. Would you adjust these numbers? And the answer is I think if it offers a better comparison. Again, you have to make the connection for the reader of the report to say, why would I do that? A lot of times, the information that we're pulling off of the tax return, you know, we can get into the whole idea of accrual basis versus tax basis inside of there. But if you know that it's a tax basis item, you know, would you adjust it? You probably could adjust it very easily to make it more comparable if you needed to. I'm wondering though that if it's necessary. So like I say, there's a lot of little tiny tweaks inside of here, but as a practical measure, I'm not sure that we're going to get that much of a difference at the end of the day. So is there a difference between a cash, you know, item and a cash item and accrual item? I don't know. I would have a hard time saying that, but perhaps. So Manish asked, why does it take so long to get the data updated? And that has to do with the Department of Statistics of Income. So basically they have to collect the data, and I don't know if it's on this one here or the next one, but the time frame for this is that they take the returns from July 1st to June 30th. So all the returns in that period, and remember the Form 1120 is not necessarily on a calendar year basis. You know, personal taxes usually are, and smaller taxes, smaller companies are in that area, but a lot of corporations probably have a different tax year. But they take all of those tax returns for that period, put them together, have to accumulate them, and then they have to statistically analyze them and then run it through their quality checks. And so it takes a couple of years to do that. And that's the reason why that takes so long. I have John out here who is suggesting that Vertical IQ gets their numbers from Powerlytics Inc. I've used Microbuilt, RMA, and currently use Bizminer. I haven't used the Powerlytics. As I said, I saw one little tiny webinar on it. So, you know, if you think it has better numbers out there, one of the things that I will say, you bring up a problem for me, John, and I'll just answer it by getting up on my little box and peddling my wares here. So take it for what it's worth. But I think if you look at what it costs to get data and what the value of that data is, and when I say the value, how do you put it in a report? What information does it give you? How does it provide sufficient, competent, reliable, relevant evidence? Then you know, I think if you start looking at the levels that are available inside of the NACFA keyvaluedata.com and what's inside of there, you know, you can make that decision for yourself. I know that there's some experts out there that, when I say experts, they're expert witnesses that say, I have to have everything so that I can be complete. There's other folks out there that are saying, hey, I just have to have this information because I have to do a peer group analysis or else I've missed the standards. And all of that has information, you know, all of that has I'm trying to say there's a line or a degree, and where you fit on that line is up to you in your practice. William out here says, I agree, IRS data is a large sample size and the categories of expenses were shown on IRS research audit we experienced a few years ago. It's 100% audit of every income and expense item. Used to determine the effectiveness of computer scoring for manual audit purposes. The example was a trucking company who put all truck expenses in the travel category. The computer bell rang as the IRS presumption was that travel was discretionary. You know, practically speaking, it should have been cost of sales. Great comment. That's why I like people to type stuff into the comment section here, and I share all of them unless they're really not relevant or, you know, they start to take away from the presentation. But William, I appreciate that information. That's why I like the IRS data too, is that, hey, this here is statistically gone over and it's pretty darn accurate. Wow, how could I come up with that? Data is statistically accurate for a large grouping of the industry. That's what I think makes this good. However, it's only using Form 1120s. It's not using other types of forms, you know, partnerships, Schedule Cs, things like that. I think that when you start to get into this law of large numbers, you're starting to look in industry and starting to be able to describe that industry pretty good. The data is sorted by asset slice, but if you run a calc, and when I get into the demonstration here, I'll show you that. When you run a calc on this, you'll find that if you take the returns and net sales, you can come up with the revenue slice. We talked about the time period. You can go out to the irs.gov, look for the statistics of income area, and you can get the intro. It used to be published as a book, now it's published as a web piece, but you can get the limitations on this particular data and see what's going into there. The other trap that I would suggest here is that if you think you are missing, if you think you're missing the, how do I want to say this? If you go to these databases that are backcasting the models, every single one of them is using this particular data set, the corporate statistics income SOI study. And I don't care if we're talking about the business almanac for ratios. I don't care if we're talking about Microbuilt. I don't care if we're talking about, you know, Bizminer. They all list it as one of the very first databases that they use. And so every backcasting model is using this data. So even though you may not think that you would like this data, and because like I say, I've heard that whole idea that it's stale. If you're using some of these other databases, you are using this data. And I had a question, but I'm not sure what happened to it. I apologize if I missed that. So anyway, I think that when we talk about these data pieces, the COVID-19 effect is going to happen and we won't see it for a couple of years. And that's simply because of the way these databases are put together. It takes a while for the data to come into place. So let's see if I can pop over to my data set here. When I log in, I come to my applications page, and I come over here to the corporate ratios. I should probably give you, where's my little annotator? As I said, you can click on Bizminer or you can click on First Research and get to those data points. And I should probably show you real quick. If I go into First Research, here's all of the different items. When I click on PDF or select, it will load it up into a cart and I have to pay for that. If I go back to the Bizminer, it's going to kick me out to the Bizminer area. But the nice thing is that you would be, this whole key value data, where's my little drawing bar? There is my little drawing bar. You can see that it's co-branded with key value data, and Bizminer obviously is working with key value data to supply that information. You can go to bizminer.com too, but you don't get to go through, like I say, NACVA to do that. So IRS corporate ratios. So as I said, ValueSource has been a little remiss. They changed the data on us and we weren't quite sure how to deal with that. So 2013 is what's up there. I believe in the next 3 or 4 months, we'll probably have up to at least 2016, if not 2017. And you can choose by industry title or, by a NAICS code. So when I come down here for NAICS code, I have a question. Jeff asks, if IRS data is considered stale, we would have to penalize the market data of our transaction bases on the same basis. And I tend to agree with that, Jeff. What I say in the market database area is if you're doing comparable transactions, you want to pick a time period that is similar to the time period you're valuing your company in. So for instance, the COVID-19 era, maybe we go back to the Great Recession of 2008, 2009 and try to pick a time period there. Anyway, so I want to drop my NAICS code down here to the 332. And so when I come here, 332 is a higher level NAICS code than some of these other ones. So if I go into the 332 to 810, I'm not quite at my 813 database. So maybe I go back up to the fabricated metal, or I could see what happens with 332, but I'm just going to go to the 332. And here again, all of those assumptions, a simple mouse click. Now, what I'm suggesting here is that metal products, metal plating, fabricating metal, all of that is what's inside of here. And I have to be aware that sometimes that data being submitted on the form, you know what I mean, it's not something that you can easily audit, but perhaps they do. Maybe there's a description that goes with it. But that's what's going inside of there. And as you go up the ladder of the tree, you're including different products. As you go down the level of the tree, you may not have information. And that's simply the way it is. So I was talking about how can I get a different size category over here. So if I look at the total, in other words, I'm not looking at how the assets, that's what this is. This is the asset range. I can look over here at the total. I can do it for the assets too, but I get the net sales and I get the total assets. And so what I can do, I can get rid of those. I'll bring up my calculator and I can take my, 265, 104, 336, add my 3 zeros, and divide that by 33,248, which is the number of returns in this category. And I can see that I have an $8 million in revenue sizing. Now I can go across my asset range and get the same approach. And so when I'm looking at my comparability here and we're trying to figure out size, you can look at the different ways of trying to slice and dice this. And as I said, what we're not going to see in the future, and I have another question here. So you're not going to get the sizing by the industry. You're either going to get the total column here for this industry, or we're going to get the total for the sizes. If I come back to the US industry total up here, if I come back up to the top, US total, then I'll get the sizes. And comparing those two across that gap is going to be interesting, but that's what's going on in there now. So I don't know if I can get back to where I was real quick. Let me try them. You can also do a multi-year, and by doing a multi-year, I can choose, you know, which, and then I can choose which particular category I want to look at. So if I'm in the 1 to 5 million, and now I come over here to my 332, and that brings up, you know, here's my sizing category for 1 to 5 million, and I can do my calculator and see what kind of average revenue I'm looking at inside of those. And as I scroll down in these different years, I can get to those different DuPont analysis pieces. So if I'm looking at my, you know, here's my net income, 7.16%. That would, you know, be my profitability margin. And then I can look at my asset turnover and take, you know, take my total assets, and I've divided by revenues. So I can take my numbers here and say, here's my total assets, multiply that out, or divide it by the 7067 to come up with my assets. And I can take my income, my revenue, multiply that out and divide the two, and I can come up with my ratios for that. And then I can look at my leverage ratios. 48% of one is for, you know, it's going to come up to that number that I need. And then I can do my DuPont analysis with this. I'm just saying you can do that on this level as well as a subject company to find out what's changed inside of the industry, what drivers are driving this, you know, how are things changing inside of here. I have a couple of questions. Greg says, don't forget with and without net income. Yes, I was going to go there next. William says, NAICS codes always need refreshing as technology changes. Reminds me of a New York State large highway sign periodically replaced, showing Pine Plains on Route 28 North. Well, that was a popular tourist destination before the airplane was invented. However, now Woodstock, New York, which was a small, little-known arts colony back then, is in the same direction, but not shown on the sign. I guess the order said to do the same as in the past. Oh, I love these comments. The IRS also has the ability over here to say with or without net income. Where's my little drawing tool? What that means is do I want to look at items with only net income, or do I want to look at it without net income? And you can get a huge difference in your profit margin, you know, down here. So if I choose with or without net income, and I drop this down and I look at my profit margin down here, you can tell that I'm at 4.65% in that particular area. And when I go with regular net income, I think it drops up to 7%. So when I'm trying to compare myself against tax returns that only have net income, or do I want to compare it against tax returns that have net losses? And I have to follow my thinking down that rabbit hole when I go down there. So if somebody has a net loss, are they throwing everything into the kitchen sink and trying to make that net loss look worse? And so you can ask yourself, what do I really want to compare myself to? So Nanish says, can you draw charts on these data? And the answer is not inside of the web app, but when you drop the data down, and in fact, you know, when I hit the data button, what's going to happen here is that I'm going to go out to the, there should be an item here. It says, let me open this, and I can open up this in Excel. When I hit that data button, that's considered a download, the green X, and now I have an Excel sheet if it comes up here in a moment. And it says application not found. Let me do it this way here. And so this is the spreadsheet, and it looks exactly the same. And so now I can use the Excel spreadsheet to draw my charts on that data, or analyze it, like I said, go out there and create my own DuPont analysis, or however I want to do that. In fact, I would make the motion here that you you set up your own standard template so that you can analyze data. You always know that you're going to use 5 years. You can modify it on a case-by-case basis, but typically we set it up for 5 years and drop those 5 columns of data in the same place, and then let your spreadsheet map back to those columns so that you can do that. And if you're sophisticated, you would add some VBA code to do that. Let me clear off some stuff here. And so the IRS data, like I said, you know, I think as we look at the population sizes is where we get the strength. So we're talking about 1 to 5 million, and we still have 7,000 companies, 6,300 companies. And if I go to the total, here's everybody inside of the industry, you know, 33,000. And if I go to the very top end, you can tell how, you know, how these are driving it too. So there might be only 10 or a few companies, but they have a huge amount of assets and a huge amount of sales. And so that's a big deal. So you have to be careful of how you want to look at that data as far as the sizing goes. Can I look at the totals or not? All I'm trying to do is show you a different way to look at this data and say, it's not just a simple mouse click. Let me come over here, put in my NAICS code, you know, put in my most current years and say, okay, give me the numbers. If I choose this total column, which is what we're going to be forced to do, I mean, what really is inside of that 33,000 number? And am I getting an idea of, you know, what's the profitability? If I come down here to my 8%, you know what I mean? And I compare my subject company against that 8%, am I doing the right things or not? For what it's worth. Now I think I need to come back to my slide deck and start talking about RMA. So RMA is the other data set that we tend to look at. So RMA Valuation Edition is where ValueSource has talked to the Risk Management Association and asked them to process the data and add this specific algorithm onto it at the end of the day. The data is the same. I like to look at this database and say it's a great database because it's based off of actual numbers, it's real numbers, and it tends to go to a small size that we can get to. It's not backcasting. Personal opinion, not saying it's good or bad. Back in 1915, a group of bankers had to get together to start to mitigate credit risk. Back in the early 1900s, this is when the Federal Reserve System was put together. There was a lot of runs on banks. There was a lot of problems with loans being, what do I want to say? You couldn't collect on the loan, so people would go and put a run on the bank because they thought there wasn't any money in it. And that's what was going on in that time period. A lot of laws and income tax laws were coming around then. A lot of changes to the world were happening in the industry. I think so Theodore saying the word I was looking for was defaulted. I think that's true. Originally, it was named the Robert Morris Association. Now, Robert Morris was the financier of the American Revolution. I like to put history with all of this so that it helps me understand. But Robert Morris basically was the guy that went to France, said, let me borrow money so we can buy muskets and balls for the American soldiers to fight this war. He created the first bank, if you will, and created the first ways for the supplies to go. Now, I personally think that next to George Washington, he's probably the most important person to make the Revolutionary War work for us and create our country, simply because supply chains are what's the most important thing there. However, in 2000, they changed their name to the Risk Management Association. I don't have any personal opinion here. I'm trying to read between the lines, but I think they changed their name to the Risk Management Association because Robert Morris had such a big deal with having United States inside of it. It was a United States hero and not necessarily an international hero. And I believe in 2000, the RMA decided to move more towards an international flavor, if you will. Most of their information is for the United States. I want to say that there are subsidiaries that are running in the United States that report, but I'm not seeing any information from banks that are international. International banks wouldn't be the right way to put it. From a bank off the shores of the United States that doesn't do business in the United States. I haven't seen that inside of the Risk Management Associations. Again, you can go out to the Risk Management Association website and you can look up their FAQs. You can go out to the Wikipedia and see the history of the Risk Management Association. But basically, these are people getting together trying to eliminate their credit risk so that you know, the loans don't get defaulted on. Every year for the last 100 years, you know, they've been putting together statement studies and trying to accomplish that. One of the nice things about having that history behind you is that you know that people are using this and using it the same way, and there's a lot of consistency inside of the data, and that's one of the things I like about it. So William out there says, we use Profit Sense to do analytical review procedures when preparing review financial statements from Sage. It's great reports. And he says it's prohibitively expensive for a dozen reports. Maybe some of the BVS programs you mentioned have a better database and offer pay per use. What I will say about Profit Sense is that what you do with Profit Sense is that you take your client's financial statements and you input them into the system. And when you do that, you have to make sure that your engagement letter, if you're a CPA, says that you can do that. I have it on high authority from an ethics committee member that says, if you give your client's data over to a database, even if it's aggregated, you breach the rules of confidentiality. And so make sure that your engagement letters say that that's what you're going to do, so they know that's what's going to happen. And I don't see why a client wouldn't sign that. You know, hey, they're going to pull their name off, it's going to be aggregated, nobody knows anything. But that's the nice thing about Profit Sense is that you put those statements in there and it does generate a report, and it says, oh, your quick ratio is 0.5, it needs to be higher than that, you know, because you're going into a risk situation, and it has that behind it. So I'm glad you brought up Profit Sense, William. Thank you so much. And Anish is asking, is RMA data more current than IRS ratios? So let me answer that question. RMA data, here again, get the intro to the book, go to the help file, or you can email me. I'll be happy to give it to you. So from April 1st to March 31st of a given year, they take the financial statements in that are for the 12 months ending anytime during that April 1st to March 31st period. Then in November of the same year, they publish the data. So in November of 2020, November 1st, you'll get a new set of RMA data that's available to you. That data contains information from April 1st of 2019 to March 31st of 2020. Now, how's that for a COVID-19 issue? I think in November, we're going to see the first COVID-19 issues come up. However, most companies are reporting that December 31st, 2019, where COVID hasn't come into play yet. So we're going to get the first inklings of it, but I don't think we're going to see the full effect until the following November. And so when we say the data is more current than the IRS ratios, yes, the underlying data that's being analyzed is more current because of that time frame. And Rob out there says, I thought RMA data was more granular than the IRS data. True? Yes, I believe that the RMA data is more granular than the IRS data. As I showed you before, the IRS data can be sliced up by size. It can be sliced up by industry. However, especially in 2014, the data years, you know, data being analyzed, 14, 15, 16, 17, you're going to find that the granularity of that is not as good as RMA data. Okay, so we talked about Robert Morris changing the name to reflect international stuff. I don't know if I talked enough about the loan officers. Where this data comes from is from loan officers who are either monitoring a deal, monitoring a loan, or they are trying to make a loan to a company. That means that these are data for loans. And the question you have to ask yourself is does my company have debt? Is it reasonable to assume that I can compare myself to these companies that are trying to acquire or have debt? I also believe that there's limited samples and data collected in some circumstances. So basically, I'm going to go out there and I'm going to say, hey, I want to have this industry and this size category, and you're going to see a blank column. And the reason for that is if they don't have 5 or 7 or 10 observations for that data set to aggregate, they won't aggregate it because it's too easy to pull out who the competitors are. The other problem with RMA Valuation Edition is that some of the definitions are not as specific as we want them to be. So for instance, officers comp. If you look at officers comp, it says, this here is payment to all officers and directors. It's not payment to one officer. And so you have a hard time making that connection. Are these cash statements or accrual statements? We don't know. Is this a public or private transaction? We don't know. Operating expenses, you know, where's depreciation and rent? Can we pull that information out? And the answer is no. What they have is what they have. As I said, the benefit to that is that these are real companies and real financial statements are being used. It's not a model or a statistical sample. And so, you know, you're dealing with aggregate information. I have a question that pops up here. It says, are you familiar about IBIS World and their database? Great question, Janice. IBIS World is great. As I understand it, IBIS World has very, very good information about the industry research. What I was having a hard time with is finding a sample report that had the financial ratios in there. Here's the quick ratio, the turnover ratios, you know, cost of goods sold type ratios. And what I want to say about that is I believe that that information is inside of some of those IBIS World reports, but take a look at it and make sure that it's not the backcasting models. Not saying you shouldn't use them, just be aware that that's what there are. It says their data reports include RMA stats, and I understand they are doing projections to include COVID-19. Well, Janice, you know more about it than I do. That's really cool if they're including RMA data inside of the IBIS World. Maybe you should subscribe to IBIS World. I'm gonna tell my boss we need to go make a deal with those guys. Thank you so much for that information. Just because you want to make a deal with somebody doesn't mean that they will. So Sheila out there says, financial data is gathered during the loan application analysis process and usually input by bank credit analysis or commercial loan officers. Some of these companies in the database receive loans and some do not. That's true. Once a year, the participating banks submit data to the RMA, and then the banks purchase the data to use in their credit risk assessment on an individual or on individual companies. She was a commercial lender for over 20 years, and the RMA peer comparison was used to determine company strengths and weaknesses. However, like with the IRS corporate ratio, sometimes the NAICS code doesn't exactly match that of the company being analyzed. I have never had somebody tell me that directly, Sheila. Thank you so much for that. Yes, I agree with every single one of those points. In fact, I was going to make a point of it here saying that this here data is being collected by loan officers. And what a loan officer's biggest fear is having the loan go into a default condition. As soon as the loan goes into a default condition, the person on above them starts asking questions. Why is this loan in default? What did you do wrong? And the last thing that you want to have as a commercial lender is to have one of those loans go in default. And worse yet, you know what I mean, not be paid back at all. And that's even worse than when you have to do a write-off. And so when they look at the RMA data, what they tend to do, and I'm going to talk about this in a minute, is they tend to look at that interquartile, the low to high range, and say, are there ratios in the low to high range? And if they are, they're probably close to being average enough. And so they can live with those. And if they're not in that range, they want to know why. And they tend to use it at the strengths and weaknesses, just like Sheila had said. Thank you so much for that information. Ari out here says, IRS corporate data based on corporate tax returns. Wouldn't the profit ratios be artificially low to the suppression of taxable income? Just curious about the accuracy of the data. So now you're asking me, you know, how accurate is the data? I always believe that if it was willing to be signed on a tax return, it is probably, you know, pretty reliable. If you want to go outside of that and say, hey, you know, these here have a lot of transactions that are being done under the counter, then, you know, I think you're talking about an individual subject company, not necessarily a tax return. But yes, I do believe that tax returns are window dressed. People will try to put expenses on there when they can. They'll try to extend the income down when they can. Or, you know, in low tax years, you know, we had a tax year changed here a couple of years ago. I'm kind of expecting that window dressing to kind of go the other way. Is there a way I can put income into a year I'm going to have a low tax rate? Gary out here says, when I've used RMA, it appears that the same ratio jumps around quite a lot from year to year, often for no apparent reasons. Gary, I don't know about that. I've looked at the data a lot, but I have not seen a particular ratio jump around from year to year. But that's exactly the kind of trend that we want to look at and try to figure out. I'm going to have to contact you, because I know who you are, and ask you what ratio it is that you were looking at. Where's my pencil? Hold on a second. But that's the trending that we want to look at. And if there is a difference in those ratios jumping around, you know, and it's a critical ratio, then we want to find out what's going on and why the industry is doing that. John says, I just looked at a current IBIS World report and it has RMA data. Sweet. I learned something today. It was worth my 2 hours. I appreciate that, John. And Janice. Have another question pop up here. It says, keep in mind when you pull the benchmarking data from the IBIS World or First Research, you cannot fine tune your search like you can in the actual databases such as Bizminer. Great comment. Put it out there for everybody to use. Okay. Okay, I need to talk about the Valuation Edition and what makes it special. What makes the Valuation Edition special is this idea of a percentile or a p-tile. So let me get out my tool, and I'm going to say I assume everybody has looked at the interquartile information, or at least this information here. When you look at a ratio, RMA is going to present something high, median, and low. So basically, they're going to take the data, they're going to arrange it from low to high, and there are several ratios that are non-linear, so you can't, you know, you have a hard time doing that, but they're going to range it from low to high. And if that number falls in this range, I'm sorry, let me clear off my mouse. I got fat thumbed. If it's in this blue category here, you know, a loan officer is going to look at that and say, okay, I'm in pretty good shape. If it's towards the high end, they're going to feel like they're in really good shape. If it's towards the low end, they're going to say, I can live with this, but it could be better. And they're going to try to add up all of those pieces parts, as I said, each individual item into the whole and try to make a quality decision as to their repayment. That's what the RMA data by itself does. What we do at ValueSource is we ask them to process the same list and put it into percentiles. Here's the 10% mark, here's the 20% mark, here's the 30% mark, and so on. By cutting it into 10 pieces, we are able to then to say what percentile is this particular subject company in. And I'm holding off on a couple of questions and answers here so I can get through my little deal about p-tiles. I need to go to the next slide and say, once you have a percentile, then you can use linear interpolation. And I don't have that on the slide here. Sorry about that, but this is linear interpolation to get to the exact percentile. And so, you know, you say between 18 and 14 is this, the subject company is 16, it goes to 14, I can figure out what the ratios are between those. That's what's going on up here. And then I can figure out what percentile I'm at by calculating this. By figuring out the percentile, I can say to them in my report, hey, the average company had 85% cost and my company was at, you know, 83%, but the, you know, and so because it was 83%, let me go to the next slide. I'm kind of getting confused here. What I'm trying to draw a difference on is saying, hey, if my company had an average of 85% operating expenses, when I come over here to the 50th percentile, it's 91%. And that's a huge difference. And this particular item is a certified public accounting firm. You know, operating expenses are huge. This is, you know, what we keep. And so if we have that, you know, you can tell down here on the bottom line that profit before taxes on average is 13%, but the median is only 7%. That means that some of these firms up here are driving it really hard. And so you can come up with the difference and say, look, my 85% is probably down here in this 32nd percentile. That means 32% of the companies in this population have a worse or have a better number than me, and 68% have a higher number than me. And that gives me more credibility in my report by saying, here's the strength and weakness of this, rather than just saying the average. I also get a better idea of what I'm looking at because, you know, the average number is an arithmetic average. We all know how outliers can pull an arithmetic average one direction or the other. And so I'm eliminating that by looking at medians and percentiles. What do I lose? This column of data will not add up. It's simply the way the math works. It's arraying those items, you know, the operating profit, the operating expenses, the profit before taxes, from low to high, and cutting that into pieces. And that's why this column will not add up. But it gives you an idea on an individual basis what those are. The other thing I need to say is that the 90th percentile is not necessarily good, 10th percentile is not bad. Again, if we look at operating expenses, we want that number to be low. So we want to be down here in this range. Profit before taxes, we want that number to be high. So we want to be down here in this range. And so it's not good or bad, depending on what percentile you're in. The other point I have to make real quickly is your population. And so if I look at the population and there's only 10 companies, maybe this whole percentile thing doesn't work really well. You know, maybe it would be worthwhile to cut it in half and find out what my median is compared to my average, but saying I'm down to the 25th percentile probably doesn't make a lot of sense. And so you have to look at that, you know, the statement counts. Going back to the high, low, and median. So I got to go back a couple slides here. Let's see if I can do that. So if I come back into my high, low, and median, and I have 10 companies, you know, so what I'm really saying is 5 companies fall in that category. Maybe that makes sense. However, you're going to have to make that judgment call as to say, how big of a population do I need? And that's one of the nice things about, you know, the RMA data is that as you start to slice and dice this information and you pull in this p-tile, it will help you understand where that company is for a particular item. And you remember my trap at the beginning, and the trap at the beginning was the pieces, you know what I mean, may or may not add up to the whole. Q&A time. William says, since business owners sell their businesses, typically only tax returns are available. Over 35 years found there are simply enough legitimate deductions, especially with Section 179 and bonus depreciation. The returns are accurate. Appreciate that. I would tend to agree with you. Rob says, in the 90th percentile, how can you have 108% of operating expenses yet still show 35.9%? Oh, great question. So I'm back here, and what happens with the data, where's my little tool? There it is that it's going to cut it off at the 90th percentile. And so anything above that 90th percentile, we don't know what the ending point is. And so we say above 90 or below 10, same thing happens on the bottom. So let me come back here to the real question and say, given that, so what we're saying is that somebody out here has 100.8% in taxes, as well as, you know, when we array the item down here, 36% are saying that's the average profit before taxes in the RMA category. Each item is counted on its own. And so somebody submitted a loan to the bank, to a commercial lender, and they had operating expenses. There is obviously a loss when you have operating expenses over 100%. Now, that doesn't mean that the lender will or won't lend money on that. You know, there's a lot of reasons a lender will make a loan. A lot has to do with personal guarantees and, you know, what other assets are available. But that's what that means, is that operating expenses by themselves on an individual category were lined up, and there was more than, you know, they brought in. Their expenses were more. By the same token, when we look at the profit before taxes, as I said, they're not connected. The line does not add up. They're not connected. That's why we get that 35% mark down there. I don't know if that explained it as well as you would want it to be. Feel free to reach back to me, and I'll be happy to, you know, either jump on a phone call or share an email thread and try to explain. But each item is on its own, and that's how you can have large numbers here and small numbers here. That's why I say, you know, the big number I like is the 50th percentile. That's the median, the average, and it tells me how far apart those two are. However, you can use linear interpolation to drive this. And I'm just using the income statement here. You can use it on any item you want. Let me go back into my Q&A session. So Nanish says, shouldn't they arrange percentile for the operating expense and net profit in the opposite way? And the answer is no, because we're always lining things up from low to high. That's what that whole process is when they try to develop their 25th and 75th. So when we try to create our 10 pieces, that's the order that it's in. And all we can do is cut it up into 10 pieces. We don't want to rearrange that order and create an algorithm that's really hard for them. It's probably more information than you wanted, but that's the main reason why. What I like to say is, it's just because something's 10 doesn't make it great. Just because something's 90 doesn't make it bad. So Steve out there says, I once had a client whose ratios were all reasonable except the interest income was near zero on large cash equivalents. It took me over a year to reach an understanding of the explanation. The company management was extremely risk averse and would not accept reasonable levels of investment risk. My more general question is when the ratios are wonky, what minimum effort must we undertake to reach an explanation? So you've just hit the nail on the head. You know, we're CVAs, we're CPAs, we are financial experts. We need to make inferences about data against the subject company to opine on a value. Usually a fair market value of a piece of our security. Let's put it that way. And what is sufficient, competent, reliable, complete evidence to make those opinions? That's the question you just asked me. And I don't think anybody can answer that except for you. Who's the client? You know, who's the report for? Is this an adversarial relationship? Is this going to be a, amiable relationship? I'm sorry, I had to grab a drink there. But that is the whole question. And you know what I mean? What does it take to be an expert? You have to make that decision for yourself. That's what the whole letters are for. Great question. I mean, that just brings in so many things, and I hope all of us realize how important that question is. You know, what is it that makes us an expert, and how do we stand behind our opinion? Which is the question that was asked. So what does the M stand for in the RMA Valuation Edition? Bankers are noted for being 3 zeros. M's a Roman numeral for 3 zeros, so 5MM is 5 million. And so you can take a look at that. Historical in every company in the NAICS code list, as opposed to saying, here's my slices. I'll show you that in a minute, but I just wanted to draw that out and say, you can't use the historical numbers in one instance and then try to use a slice of data in another instance, simply because you've mixed apples and oranges really badly. And I'll try to show you what I mean. I do believe that you can use your asset slice to find a new revenue slice number. So although RMA likes to slice and dice things by their revenue slices and their asset slices, by changing it around and doing your calculator, we do it for you automatically. It's real easy to see what an asset slice is to turn it into a revenue slice. I also highly recommend that you get the intro to the book. It explains how the items are calculated. As I said, when you're looking at how the 25th percentile, how their low is being calculated, think 25th percentile for us, and that's how we calculate that 25th percentile, and then we turn that into deciles. Also inside of our help file, we tell you about the algorithm. Okay, this here is the computer code that we use to find those 10 slices. It's very transparent that we like to do into that. So let me come over here to the RMA data set. Now you can do a multi-year search or you can do a single year search. So I'm going to leave it at a single year. Right now, 2019 data is available to us. And so when I drop my list down here, I'm going to go to the 332. And in this case, oops, went too far. I can go exactly to 332,813. So I'm going to go there. one of the bad things about RMA is that, you know, it's hard to go up the ladder. They have their specific categories, and it is their specific categories. So we're going to use that specific category. I have a question here. Okay. CPE question. Then I come over here and I can sort by assets, sales, or historical. So when I look at historical, I don't get a slice anymore. This is all of the companies inside of this code. And as I come down here, where's my little tool? You can tell that this is how many companies are in this code. And believe it or not, my zoom bar is holding that up. So there are 98 companies inside of the whole industry list. So in 2019, what we're talking about is from April 1st, 2018 to March 31st, 2019. Anybody that had 12 months ending inside of that period was aggregated. There were 98 of those companies that had applied for loans or were maintaining loans with a commercial lender. That commercial lender sent that over to the RMA, who aggregated it. And obviously the commercial lender gets access to that, or they buy it back to make their lending decisions. We've taken that data, twisted it for our purposes and valuation, saying, okay, let me do an industry analysis off of this. And that's what's going on there. I have a Q&A question here. So Calvin asks, can you use multiple NAICS in one search rather than each NAICS in RMA? And the answer is no, it's one NAICS at a time. You can download as many of these as you want, but there's no way to combine. In other words, the database, it's a SQL database that's behind this, is listed by historical, assets, and sales, and it's listed by, you know, the NAICS code, and there's no combining the data. RMA is very careful about aggregating those forms so that you can't pull out that information. Would be cool though if they had individual items in there and you could say, oh, pull in this slice, and this slice for these companies here, and come up with it. But it is what it is. So historical has 98. So now if I go to the asset slice and I come down here, I can tell that I have 10 in this particular asset slice. And as I work my way up the list, I'll point this out again. Let me clear my drawings. Let me come over here, get my tool. You can tell that I have, in this particular area, my sales is 1.8 million. And so even though I'm in the asset category, my average sales for that asset category is 1.8 million. And I can look at that and say, do I have a new revenue slice? And as I look at my revenue slice, you know, I can decide whether I want to keep that or not. With 10 companies inside of here, I'm starting to get on the bottom side, especially if I want to use that p-tile information. So let me click on my mouse here and let me go over to my sales slices and see if I can't get a little more. So I got 2 million in sales here, excuse me. And I got 13 companies on this one. So I got a few more companies. Is it enough? Not enough? Hard to tell. Maybe if I jump up one category, I get 20 companies in this, so I have a better sampling size, you know what I mean? But my average is now 7.5 million. Would that be worthwhile to compare myself against a $3 million company? Maybe, maybe not. I'd have to do the analysis and look at it. Again, I come over here to the income statement. You know, we have our decile information, and you can tell that the average over here is profit before taxes is 8%. If I look at the median, 8.3%. Not a big disparity there. So I got a pretty good sample. Maybe that 21 is probably good to look at. But I can start to analyze this. Greg out here says the Z-score is often relevant. And also maybe says more so with the COVID. Let me show you that, you know, in our single year category, I can get rid of my Q&A thing here. I believe that we have a Z-score. And so we have the Z-score calculated on here automatically for a public company, closely held. Those are just different formulas you can look up out there and see what it is. But that's already calculated for you. One of the ideas that I like to present is, you know, how much information can we automate and put on here so that you can, you know, take that and not have to do the ditch digging inside of Excel to calculate those. So as I said, that's what the income statement looks like. That's what the balance sheet looks like. And then the ratios, you know, so you get high, median, and low. That's the 75th. That's the 50th. If you notice, that 3 will match up to that 3, and the low is here. Now you have to be careful about some of these items because they go in weird categories. Is it sales to working capital? A couple of these are in non-linear fashion. And by that, I mean that when you start to look at those, they're going to go from the highest low to the lowest low, and then they're going to go from the lowest high to the highest high. And so it goes from, like, you know, -1 to -999, and then it goes from 0 to 10. And so there's a little crossover inside of there, and that's what the problem is. What I will say is that when you see numbers like this 999, here again, you know, the intro to the book explains that. That means that when you calculate sales to working capital, the number is just so large, it doesn't make any sense anymore. So in this case here, you know, working capital is probably really, really tiny, I'm guessing. Working capital is either really, really tiny or really, really big. And so that's why that number shows up. And then there's some NAs, which means that it can't be calculated, or there's not information inside of there. As I work my way to the bottom down here is the other cool thing. And a lot of people don't do this, is that they don't look at how many companies are included in each of these ratios. So a company may be reporting oh, it's out here on the side. So a company may not report. So we have a sample of 21, and here there's only 17. What that means is that 4 companies did not report enough information for EBIT and interest. Basically, they didn't have any interest, is what I'm thinking. So that's why they don't have that in there. Does that change your analysis very much? You have to look at it. I'm not saying it in practical terms. It does a heck of a lot to change things, but in theoretical terms, you need to take a look at that and see what's going on. At least ask the question. So John says 55 days WC average. So I think what you're trying to get after is you know, they have numbers up there, and then down at the bottom we also have you know, the days calculation too. So sales to AR turnover is 49, 50. I'm not sure if that's what you're trying to get after, but there are days calculated inside of here as well. So Nanisha asks, does NACFA support key value data? Is there a special pricing for members? And I know you're not promoting it. So the answer is key value data has different levels. Value Source and NACFA both sell those levels, and it just depends on who you want to deal with, if you will. The pricing is the same. The lowest level is around $500. The next level up is about $800. Then the RMA comes in the platinum level. That's around, I want to say $1,700, maybe it's $1,600. And then you can get all of the databases that are available for around $2,900, something like that. So Roger asked out here, how does RMA compute the Z-score? RMA does not compute the Z-score. That's something that Value Source adds onto it. Again, we can come out to the help file, and inside of the help file, we can, you know, find out how that's being done. And so if you want specific information on that, email me and I'll be happy to reach out to you on an individual basis and tell you, because I don't know the formula off the top of my head. There's a lot of differences between the private company and the public company, and what goes on with those. Where am I at? I have 2 or 3 minutes left. I'm trying to think. I didn't show a multi-year analysis, so let me click over here on multi-year. You can go up to 10. People typically do 5. Let me drop my item down here to the 332. And, you know, let me pick a sales slice here, 1 to 3 million. And you can tell that what we've done is that we just have the different years coming down. So in this case here, we're looking at a common size balance sheet. You can see the different years. Again, you get the information out through data. If you choose the analyzer tool allows you to type in a subject company and it calculates the subject company's ratios against that, especially when we're looking at P-tile information. So if trying to figure out what P-tile you're in, you know, for, hey, here's my gross profit, you know what I mean? What's the P-tile information? The analyzer tool will help you get there really quickly. You don't have to do all of that linear interpolation by yourself. But if you're just looking for the data, you hit the data button and out you pop. Clear my drawings, hit my mouse, try to come back to my presentation. And as I wrap things up, as I said, reach out to me, dmiles@valuesource.com, connect with me on LinkedIn if you want. Pretty easy to find, call up ValueSource, you know, ask them to transfer you over to my extension or get a phone number for me, that works too. We've talked an awful lot about what key value data has to offer. We've talked about a few databases that are out there. I personally believe that the meat and potatoes of trying to figure out these competitive advantages is in that subjective interview and in this analysis of the company. At that point, you know, I think it's easier to normalize and move forward and try to figure out what the probability of the cash flows is in the income method, what the company specific risk is in the income method. If we're looking at a comparable transaction method, we can say, hey, my company is strong, it deserves a strong price. How do I calculate that strong price? Or my company's just average. You know, a lot of companies are just average. And if that's the case, you know, that makes life easy. You can just do your regression line, boom, move on. You know, the real question is on the other side of this, is somebody saying, hey, I'm really strong in the marketplace. And you've only given me a middle price here. Why aren't I getting a stronger price? Because, and now all of a sudden you see all the things that I would lay into this and say, hey, I have a pipeline for revenue. I have a supply chain that can't be beat. You know, I have a production facility and people in place that are, you know, not going to go away. And now all of a sudden somebody's saying, well, that's the kind of thing that drives the price of a company up. And so, you know, typically when we talk about fair market value valuation of a security, we tend to talk about cash flows and discount rates and growth rates. And those are all dependent on this other information. And we tend not to talk about the dependent information. Let me check my, no Q&As at this point, Colin. I want to say thank you for spending a couple hours with me this afternoon. I like talking about this stuff. Reach out to me. Colin, I'm going to turn it over to you and you can go ahead and close this down.
Great. Thank you, Dave. Thanks for doing that. Just remember, everybody, that the CPE certificates will not be available for a minimum of 2 to 3 weeks. So be patient with that as we crank through all of the many CPE certificates that have to be created. We're thankful for Dave and his efforts today and ask that everyone stay safe and have a great afternoon.